afternoon, everybody. Welcome to this policy session on bank regulation and crisis management in an era of recurrent crisis. I think this is a very timely topic, and it is also part of the IWFSAS conference, which stands for the International Workshop on Financial Architecture and Stability, which we had one full day of meeting today and tomorrow as well. So I am Rima Yadi. I'm president and founder of the Euro-Mediterranean Economists Association. Also, I am connected to CEPS, since this is where I worked so from 2001 to 2013. And now I am a senior advisor. I'm also acting as the chair of the banking stakeholder group of the European Banking Authority. And this topic is quite important, in fact, based on what we have learned from the previous great financial crisis of 2007-2008, but also the crisis that we've seen, in fact, in the United States of SVB and Credit Suisse. So in fact, what we've seen that we are still seeing a recurrent crisis. This is not over. And I think with the new changes in the financial systems, we even are going to see more. I mean, there are big, I would say, shocks that we've seen. For example, the pandemic. Of course, in the pandemic, there has been quite an important action from the policy makers to really help the financial system also be, in a way, solution for all the difficulties that have happened previously. But also, we've seen the situation now with increasing interest rates and inflation, where the financial sector has to be prepared for further changes. Now, if we look at the banking sector as a whole, since 2007, 2008, it has been largely strengthened. In fact, there has been an overhaul of the financial framework, regulatory framework, in terms of the increase of capital, of managing the leverage, and also liquidity regulation, and most importantly, supervisory oversight and more transparency, in fact, in terms of the disclosure of the supervisory outcomes, which have helped a lot the market to understand the riskiness of the financial sector. But this is why I think we are, in a way, in a new area of more information there into the market that has to be very carefully used to ensure that the financial sector is stable but also resilient to external shocks. Of course, preparedness is very important. And today, this morning, we had Jose Manuel Campa, who is the chair of the European Banking Authority, and he said clearly that yes, there should be preparedness from a regulatory standpoint, but also from the crisis management. But beyond this, flexibility is needed, and also all the logistical aspect. When there is a crisis, what we could see, for example, in the case of SVB, reactions and actions have had to happen in 24 hours, because a run on a bank is not anymore a run based on going to branches on a Monday, but in fact, it's a virtual run on a bank, and this happens because of social media. So these are all new realities that the regulators will have to deal with. But then again, when the SVB and the Credit Suisse later on happened, it was quite surprising. We thought that the financial sector is strengthened and the regulators are on the top of the situation, but clearly we've seen that this was not the case at all. And then, in reality, the regulatory frameworks and also the crisis management frameworks, they need more strengthening, particularly in the case of Europe. Jose Manuel this morning mentioned that Europe was lucky, and I think it was, because there has not been really a fundamental contagion that has happened. One day, remember, when Credit Suisse happened, everybody's eyes were on the Dutch bank, and there were many articles that were looking to, in fact, okay, maybe Dutch bank is the next one in the line, but hopefully this did not happen. So what we've seen in the case of SVB, and I think we need to understand a little bit the specificities of this SVB. In fact, Michael Barr, who is from the Federal Reserve, in the report that they developed and his testimony to the Congress, he said is a textbook for risk mismanagement. And I think this is also something that really needs to make us think what has happened in the case of SVB, very small, tiny bank, in fact, which is concentrated. Okay, it could be big, but then it's not really this systemic bank. It's a regional bank, which in fact led to this financial crisis or banking crisis in the US. So if we look at the SVB case, it's overly concentrated business model. It serves a very specific sector and also failed, in fact, of bank, its bank management did not effectively really manage the interest rate and liquidity risks. And these are what made the bank really become very much vulnerable into the situation they were facing. And also, it's a case for regulatory failure because the supervisors, in fact, there has been many alerts and nobody acted on the alerts. And why that was the case? Because most probably there was not really a bank which could be systemic or at least looked at as a systemic bank. So this separation between systemic and non-systemic nature of banks perhaps needs to be looked at very carefully because it's not only a matter of size, but also a matter of probably business models and other aspects. And also, it was interestingly enough, the stress test was postponed in 2024, so it was not really a stress test for the SVB. And this is also another aspect which, in fact, the stress test, although there has been a lot of criticism about, okay, the validity, the methods, the models, the assumptions, but still it's a nice tool to understand or to assess the resilience of the banking sector. So there are many aspects of the SVB that we can learn from over time, and also the Credit Suisse, which is very similar, but then of course Credit Suisse is much bigger, and we've known that Credit Suisse has difficulties since 10 years already, but no action has happened back then, and it happened that with the contagion from SVB, the case of Credit Suisse came into light, and they had to merge with UBS, and it was a forced merger really to save the stability of the Swiss financial sector. This situation could happen in any other country, and I think this is something we need to keep in mind over time. So the shocks are still there, and we can still see what I call recurrent banking crisis. So this panel will discuss particularly what can we learn to strengthen the regulatory and crisis management framework for banks in Europe. And I would like to welcome the panelists today. So on my left-hand side, Sebastiano Laviola. Sebastiano, he's a Director of Strategy and Policy Coordination of the Single Resolution Board since 2019. On my right-hand side, we have Joe Swinchido, who I've known since many years, since 2011. He's in the National Bank of Belgium as the Deputy Director and Head of Financial Stability, AML, Supervision and Prudential Policy. And Christian Stiefmüller, and he's a Senior Advisor on financial regulation at Finance Watch. Finance Watch, everybody knows, I think, here is a Brussels-based think tank and advocacy group representing the interest of European civil society in finance. And Christian, he's also a member of the banking stakeholder group of the European Banking Authority. So starting the discussion, I would like to start with Sebastian about how do you see the framework, the resolution frameworks, and then crisis management overall, and what really has emerged from what we have seen, in fact, in the banking crisis of SVB and Credit Suisse. Please, the floor is yours.
Thank you, and good afternoon, everybody. Thank you for the introduction. Well, in a nutshell, Raim Ayadia has already illustrated some of the failures that happened in the US and in Europe in Switzerland. So this was the most significant system-wide stress since the great financial crisis in terms of scale and scope. Because if you sum up the amount of assets of the banks involved, the 4 banks in the US, there was also a small bank with respect to the 3 ones that are well known, and Credit Suisse, you arrive to something, it is a measure of stock, not of flow, but if you compare with the flow of GDPs of European countries, you would find important amounts, like 2/3 of the GDPs, for example, of Italy. So it's an important turmoil that happened that in the end was well addressed, was solved, that the financial stability was regained, but certainly there was a certain amount of stress. Now I will concentrate, not to overlap with the colleagues, only on resolution part and not on the banking supervision area or risk management from the point of view of the banks. The moderator has already said something regarding the basic risks that have not been looked after by the management of the bank. And from the resolution point of view, the first question that was put in the public domain is, but after a lot of efforts in the international framework, then is the resolution framework adequate or not? Because in the end, there have been crises, there have been different solutions, some solutions not really following the framework, so is it adequate or not? The answer is already you find in the press release of the FSB of July that the regulators ask themselves, of course, this question, and it is that the broad framework, that's to say the key attributes for the effective resolution of banks is adequate in terms of broad principles, which then have to be put in place. And what does it mean? That certainly the crisis showed a number of implementation issues. Which are these ones from the resolution point of view? Well, essentially, in the case of the large CSIB, there was, as it has been declared publicly, an executable resolution action, but an alternative which was preferred at the end was chosen. And then the question is, what happened, why it was not chosen, what were the implications, etc. And in the case of the US, in a nutshell, you have seen that banks that are deemed to be regional in the US, I specify regional in the US, but in the EU would be large, because 200 billion is not a small bank for Europe. They had the potential to create impact in death. Not in life, but they became systemic in debt. Why? Because the business model was similar to other regional banks, with not so extreme as in the case of SVB, but still a large percentage of uninsured deposits concentrated in a small number of liability holders that clearly are the most volatile, some concentration in the same market on the asset and liability side, plus appetite for short-term growth and short-term profitability. So clearly there is something to reflect on that, on the risk management by the banks, so the governance of the banks in this fashion. But coming back to the resolution aspect, I would say the first thing that comes to the attention is in the case of the 3 American banks, they were essentially addressed the failures applying the framework that is available in the US. So there were bridge banks and then selling to a purchaser. In 2 cases there were bridge banks, in the 3rd case there was directly selling to JP Morgan. So, and these reflected the framework and reflected the fact that shareholders were wiped out. The liability holders, different from unsecured creditors, lost money, that's to say those that held subordinated instruments, and then the bank was given to a purchaser. The money that the FDIC has spent and will still spend will be recovered from the banking system. and this is already public news. In the case of Credit Suisse, as we know, there was a solution which we have to acknowledge and recognize that stabilized the situation, so financial stability was restored. However, it was outside of the framework of resolution, and it is they use in the end a tool which is available in resolution, which is the transfer tool. That's to say, to sell to somebody else. Now, leaving aside of the fact that it was sold to another GSIB, the crisis showed that you need to have better flexibility and optionality in the resolution strategy. That's to say that you have to be ready not only for putting in place one strategy and one tool, but maybe more than one, according to the type of scenario that takes place. And particularly the bail-in, which is the most widespread tool, well done, well prepared, etc., is effective, but particularly for capital crisis, for solvency crisis. Less so when there is a liquidity crisis which is driven not by an insolvency, not by slow burning problem in the asset side, but by, as it happened in crisis in confidence model, in the business model, so crisis of confidence, or other idiosyncratic cases like anti-money laundering case, like geopolitical events. You remember in last year the crisis of Sberbank with the start of the war between Russia and Ukraine. Immediately the Austrian bank, which had the parent in Russia, failed, and therefore there was an immediate run to deposits. So this means that you need more tools to be prepared, and this is an implementation issue for the authorities. A second one is that we, all the resolution authority, are stressing the banks to be ready also to put in place adequate liquidity funding measures, not only in ongoing, but also at the time of resolution. So this means not only the liquidity that you have available to bring to the central bank, so that the assets that you pledge at the central banks to obtain liquidity, but other type of assets that maybe are not eligible for monetary policy purposes, but they have to be mobilized, so identified and mobilized at the time of failure. So this is private money. But in addition to that, the needs for liquidity, given that there is a perceived crisis of confidence, uncertainty, may be higher, particularly when the size of the bank is large. And therefore, we have, for example, in the banking union, we have the single resolution fund that can be used for these purposes. We have the stability backstop of the ESM that can be added on top of that as soon as it is ratified, but everything is ready. However, there can be tail risks that one has to be able to face. And therefore, here there is some food for thought also for the authorities to be able to face also these extreme events. In the UK and the US, you have ex-ante, known and public mechanism that can be used to this purpose. So this is another area of reflection. A third one is that cross-border cooperation and exchange of information. So particularly in the case of banks where the problems may go beyond the border of one jurisdiction, as was the case of the GSIBs, the cooperation worked excellently within the authorities involved in the crisis management group. We have, according to the standard of the FSB, we have crisis management group. That's to say, home and host authorities that get together and prepare for this unlikely event. But in this case, materialized event. However, there can be indirect effect, even where the establishment are not there, even where there are no establishment of the bank, but because of the complexity of the transactions that other jurisdiction may feel. And therefore, it is important that on a need-to-know basis, the main jurisdiction of these cross-border groups at a certain point, in different ways, are involved in this kind of preparation and information exchange. So this concerns the cooperation among authorities, even outside of the core group of those that normally are involved. A final one, I don't want to take too much time, that has to be considered is this speed of bank runs coupled with the digitalization challenges. Now, the speed of bank run is the fault of the digitalization or something else? So it is an egg and chicken problem, or what is the cause? If you compare what happened in Silicon Valley and what happened in Credit Suisse, you compare with the great financial crisis or all the crises that have happened in the past, you would see that there were sizable amounts of deposits or liabilities moved, but within days or weeks. In SVB, we had 40 billion in one day. And if the bank was not taken over by the authorities the Thursday, the Friday, there would be another 100 billion. And in Credit Suisse, in October 22, not in March 23, but in October 22, since there were some uncertainty, etc., this is publicly documented, there was a strong run of the investors on the accounts that didn't provoke that the ratios of liquidity went below the norm, below the standard, but was unprecedented because it was at about 100 billion. So you understand that the amounts we are talking about are very, very big. So now, clearly the case of SVB is a little bit special because, as I said, there was concentration on the asset and liability side of the same type of customers, large corporates, venture capitalists, startup firms, etc. And the bank has no limits, as it was said in the Fed reports, no limits to credits, and there were no limits to transfer of the accounts through the apps, through the platforms. At least for households. Now, I don't know for large corporates what happened in Europe, but we all have limits of transfer of money. And there was a large quantity of uninsured deposits with respect to the covered ones. So this means that the accounts were way above 100,000, much, much higher. And therefore, clearly, it was a peculiar case in terms of business model. Now the discussion regards the level of coverage of deposit insurance, the scope of deposit insurance, the interaction with the resolution framework, and so on and so forth. I would say from my own point of view that the US, bear in mind, have already a threshold of deposit insurance of 250 billion. So it is not 250,000 dollars, and we have 100,000. Okay, so per depositor. So they have already a high coverage, but here the amounts moved were much higher. Now the solution is unlimited insurance to raise the coverage to I don't know how much, 1,500,000. I think that this, in the end, will not be the debate and the solution because, first of all, it is extremely costly for the banking system because clearly higher is the threshold, more you have to pay ex ante. Second, if the problem is this very, very large amount, very much concentrated in a small number of liability holders, of depositors or other liability holders, this doesn't change, because the amounts would be much higher. And therefore, even to separate business accounts from other type of accounts lends itself to arbitrage movements. It's very difficult to identify. I think that what has to be done from the supervisory resolution point of view is better monitoring, identification of the features of the depositors, very, very important and strong communication ex ante regarding the awareness, so education education in real sense of the customers, and then good communication. The important to avoid the bank run, because when the bank run starts, you don't stop it. You cannot stop it. You have to avoid that the bank run starts. And therefore, a good communication from the bankers, from the authorities, well coordinated on the fact that the fears are unfounded, that the solution will be found, that it is there. This is what, in the end, would provide confidence to the general public. I speak most of all of the investors, those that move a lot of money. So these are, you see a number of implementation issues or initial lessons learned, I would say preliminary, that will be reflected upon and debated at international level, at national level. Thank you.
Thank you very much, Sebastiano. You said something which raised my attention. You said that when a bank run starts, we cannot stop it. And at the same time, with digitalization, the speed of bank runs is going much faster than before. And the communication between people with social media and so on, it's even accelerating the process. So all the tools of crisis management that you have put in place, and you mentioned that we need more tool and more communication and transparency also with the other policy people involved. Does it really work if in all this new, I would say, system that is really going faster and faster, and at the same time, in my view, with artificial intelligence, information probably is going even to a higher level in the market, most probably then within the regulatory ecosystem?
Look, I think that first of all, does it really work? I think that, as I said, you have to work in such a way that confidence is not disturbed, not destroyed, because then it is difficult to recover this confidence, and then you need, public interventions. But all the construct after the great financial crisis is about safeguarding financial stability and avoid, to the maximum extent possible, taxpayer money. No? So these are two important goals that the authorities have to try to preserve. Therefore, I believe that, look at what happened in the US, fine, but what happened in the EU? There was a large movement of depositors. There was a movement across banks, because, in the US, what happened? Movement from regional banks to large banks, inflows and outflows to the money market funds. In Europe, there was essentially no movement across depositors, but movement for money market funds, but much, much less than what happened in the US. Therefore, this means that I would say, first of all, the business model of that bank, maybe of other banks, was pretty extreme, first thing, for the reasons that you said, that I said. Second, probably doesn't concern retail, concern corporates. These corporates probably will have to be monitored. And there has to be also diversification on the asset and liability side. You can do this also with liquidity requirements, but here I'm not the expert, not anymore at least, but there are two experts that come from supervision and therefore will be able to give you also some to address, at least in part, this question. So the digitalization is clearly a challenge, clearly, and we cannot say we avoid digitalization, because this means avoiding the modernization and the fact that you want to even work on your account, your finance at a high speed. No? So this is clear. But at the same time, we have also to see which are the type of customers that really then use and move these amounts. They are not certainly the large majority. And we have to see if there are limits in the banks, if there are not limits. So, it is a complex type of issues to be addressed, I would say.
Absolutely, it is. So monitoring beyond banking, in fact, we have to go to the exposures of banks and monitor them, which is also quite interesting. Thank you very much, Sebastiano. I would like to welcome Delphine Raymondon, who is the head of liquidity leverage, loss absorption and capital at the European Banking Authority. And she has been taking this role since 2019. Delphine, thank you for coming and joining us today from Paris. And please, the floor is yours.
Thank you very much, Rim, and good afternoon, everyone. So, indeed, what I would like to do today is to maybe give a perspective on the debate that we are currently having in the regulatory and supervisory community, following what happened in March, and Sebastiano already described this event very well. You know that there has been already quite some numerous communications from the regulatory community in particular on this lessons learned exercise that is currently taking place in particular at the Basel table, but not only, where the idea is really to stock take what has happened in March and draw the lessons from a regulatory and supervisory perspective. I did not check, but in principle, I think it was this afternoon that the Basel Committee was supposed to publish the preliminary report on the findings. And so you will see in this report a kind of cascade that is explained on what the international community believe, what are the different steps that we should look at. And so you will see there is large agreement in the regulatory and supervisory community that following what has happened, in order to ensure the resilience of the banking system as a whole, the cascade is more or less the following. So it starts first from let's say, the bank's own risk management and governance. This includes in particular also the viability of the business model. And then it goes to, let's say, a kind of strong and effective supervision, also with heightened scrutiny on some aspects and more resources to be dedicated also from the supervisory side. And then at the bottom, I would say, you have the reaffirmation that, of course, we need robust regulatory standards. You remember that the Basel Committee also published end of last year this kind of so-called evaluation report with its conclusions on the effectiveness of the reforms that have been undertaken all these last years, coming to the conclusion that all the reforms, and in particular the ones related to capital, liquidity, leverage, among others, have indeed contributed to an increase of the resilience of the banking system. Now, and there was at the same time this concept, these last years, of this hard stop concept, which was aiming at stopping any new regulation, stopping any new change in the current regulation, and focusing only on new areas of risk, like cryptos or ESG, for example, under the assumption that we now have quite a detailed regulatory framework to address all the existing risks, and so we should pause a bit. And of course, the debate following what has happened in March is, does this still stand, or do we need to go back a bit or to challenge this hard stop principle? And this is where, of course, all the debate is about regulation versus supervision. The areas under investigation at the moment are, with no surprise, liquidity, IRBB, and capital for some aspects, in particular in terms of the role of AT1 instruments. with what happened, of course, I mean, to the write down of the 81 instruments in the Credit Suisse case. If we focus maybe a bit on the liquidity aspects on the LCR, so it's of course it's very interesting discussion. So the work that we'll have is really to first go back to what is the LCR meant for. NSFR will also be part of the reflection. And probably we first need to look at what we have at hand before deciding on the way forward. And so the LCR in itself, and it's important to recall this, is not really a crisis management tool. It's something which has been designed under a short time horizon to protect the bank in case the banks get into trouble and leave sufficient time to supervisors or resolution authorities, let's say to relevant authorities, to have a bit of time to find a solution, let's say. But this LCR is not a standalone measure. It comes with a lot of additional tools that are at the disposal of supervisors, which are usually called additional monitoring metrics, which are key from a supervisory perspective. Because these metrics, and they have been existing for quite some while, quite some time, for example, give supervisors information on the concentration risk, the concentration of funding or per product type, gives information on some maturity mismatches, on the rollover of funding in particular. You also have, as EBA, we developed quite some detailed guidance, for example, on what is called the ILAP, so where the banks have to prepare and have ready a lot of information on, I mean, for example, the intraday liquidity risk or their stress testing or their contingency funding plans. You also, of course, have all the recovery plans, which banks are in the process of updating as well. So plenty, I would say, of tools. As EBA, we also published several LCR monitoring reports where we gave some guidance to banks and supervisors on, for example, when you have in the LCR some outflow rates for certain types of deposits, which leave a bit more room for judgment on when for some types of deposits, which outflow rates to apply, like operational deposits, for example, how you define this. So we provided this guidance, which we believe was quite useful, and we are currently having a look on how it has been implemented. So what I'm trying to say is that at the end, when you look at all the things that supervisors have at their disposal, it's quite a lot of tools. It's certain that until now, the focus of the supervisors was more on capital aspects, so on the ICAP and capital. And now they will have, and I'm sure you will have something to say there, but they will have to change a bit their focus, but it's part of their daily job, going from capital to more liquidity aspects in particular. So yes, we will investigate together with other international regulators if some fine-tuning might be necessary to the LCR, changing some outflow rates, see if also how this increased digitalization could and should be addressed and how to do this, for example. But at the same time, and it was a bit alluded to by Sebastiano, we should not forget, because when you think about it, what would then be the solution? Having an LCR of 200% or 300% instead of 100? There will also be reflections, on how you compute, for example, HQLA, so the high-quality liquid assets, depending on the accounting classification that they have, if they can be monetized or not, or if they should be not only just at fair value, but in accounting portfolios that would allow to immediately show a loss in case there is the sale of the bonds, which was something that we observed in the SVB case. At the same time, you have accounting rules, for example, between the US and the EU, so between US GAAPs and IFRS 9 that are not the same. So it's plenty of questions that will have this debate, but at the end, main question is indeed, is it possible to address this increased digitalized environment that we have now and to prevent a bank run via changing the design of the LCR? This is far from being obvious. And for the time being, probably the conclusion would be that what we have at hand and what we need to deal with is supervision, is the best tool that we have at the moment. It will need, as I mentioned, to be heightened on some aspects, but we need first to see if we apply all the tools that we have, where are we, and do we still believe that then maybe some fine-tuning to regulation would be needed. So this is the current reflections. Of course, it would be obvious that all the international standards, an additional layer would be that it's applied consistently by all jurisdictions across the world. Maybe I can say also a few words on IRBB, because as you can imagine, it's something which is also a very important area for the time being. So it's not only liquidity, but IRBB, given the interest rate environment that we all know. It was already an increased area of focus. It's not directly linked, this one, to the March events. There is still a bit of a link, because as you know, in the SVB case, in particular, having some of the IRBB metrics applied on this bank and some of the so-called supervisory outlier tests might have revealed some of these issues that were later encountered. But anyway, scrutiny of supervisors have also increased there. As EBA, we also have what we call some scrutiny plans, because after all these years of very low interest rates, it's clear that the banks need to have a look, and supervisors as well, to their modeling assumptions for the behavior of depositors. This is something which is extremely tricky to do, obviously. They need to adapt their hedging strategies as well. We currently have also quite some detailed discussions from our side with the banks on all these aspects. The reflection that the Basel table will, of no surprise, be the same as the one we had many years ago if we should go from a Pillar 2 approach, since IRBB is today purely a Pillar 2 approach, to a Pillar 1 approach. Some supervisors like Australia, for example, have made the choice of using a pure Pillar 1 approach. This might probably be quite difficult to implement in the EU, given the very different structures of all the EU markets, but this is a debate that will probably also take place. And as I was mentioning a bit earlier, also some debates on the loss absorbency of AT1 instruments. So all in all, yes, so reflections on possibly amending some of the regulatory aspects, but really with no intention or no clear conclusion made on this point yet, until we finalize the kind of fact-finding exercise, including investigating a bit more from the supervisory side if the toolkit, the full toolkit on all these aspects can be judged as being enough, together with the standards that we currently have, to address other possible situations of this type. Thank you very much.
Thank you, Delphine. I think you mentioned something very key, which is moving now from capital, since the situation of capital of banks has been strengthened, into liquidity. And there is a clear interaction between capital and liquidity supervision. But beyond this, also emergency liquidity assistance. So this is the third point, which in fact we have to connect with it, because in fact, in stress situations, you need emergency liquidity assistance. We've seen that the Fed has done it on time, and they did it quickly, in fact. And I thought this has solved a much bigger problem, most probably in the US. But then if they wouldn't have done it, most probably the stress would have gone beyond the US and in big waves. So this is why your point on liquidity regulation, okay, the regulation is now there. The Basel III has already given ample information about that. But then now the liquidity supervision, this means that you need much more resources for more, I would say, hands-on supervision on the liquidity positions of banks via the tools that you mentioned, LCR and NSFR. I know that there has been discussion about, criticizing in a way this NSFR and how to deal with it over time. But I think, as you mentioned, this gives a kind of a view on the liquidity position of banks. And the LCR, for example, in the case of SVB, it was 70%. Normally should be required 100%. But I'm not even sure 100% is the right number. I don't even know whether this is the right number. So, but 70% was below the 100%. And this is what also raises a lot of, I would say, concerns in that sense, and how the supervisors did not see it. And this is also something really quite impressive, from the US standpoint. The second point, you mentioned the IRBB. In the US, they have not even applied it. And I think it's not only for small banks or regional banks, but also for even large banks. They have not transposed it yet. And I think this is also a bit of a global coordination at the Basel Committee, because I think we clearly see that there is a contagion here, at a global level. And then a country like the US, if they don't transpose something like IRBB, then this is also a prize for other countries, like for Europe. So this is also, they have to deal with it, or maybe Europe has to push them to do it. I mean, there are many aspects when we talk about the global financial system, but again, with digitalization, this will be even faster. And I don't even know whether supervisors or even regulators will be able to move as fast as the market nowadays. So this is why my view is, at least my humble opinion is, we will have much more frequency of crisis. And I do not know to what extent and who is going to pay for it. But anyway, I leave my reflection here, and I move to a supervisor, Joe. So you are from the National Bank of Belgium. I mean, Belgium has a few banks, but also large banks that are cross-border. So how do you see all of this?
Yeah, thanks, Ryan, for setting the scene, and thanks all to the colleagues. I will speak a little bit both on the regulatory and the supervisory part, and I think I looked into Delphine's briefing notes when preparing this intervention, but I will work around and make some assessments of what you said previously. First of all, where are we with dealing the previous crisis? The global financial crisis, it's 15 years ago. Basel II and III was there to address the issues. Where are we in Europe with Basel III? There is a political agreement. You know, we as National Bank of Belgium, together with others like our Dutch colleagues, ECB, EBA, were always quite vocal that we think that then in Europe the transposition of Basel into the European directives is not in line with international standards. And the events of last March did not trigger to revise that position. And of course, the political decisions are there, but I think the debate is not over. And will not be over soon. And it is even more lively than ever due to, for example, what's happening in the US, where they came up with their proposals, consultation quite recently, also in the UK. And it seems to be that these jurisdictions will be stricter than in transposing the international Basel standards into their jurisdiction. So it is a missed opportunity, I think, not to be more in line with international standards. And you see now in literature that they discuss or they talk about the transatlantic rift is emerging. I personally think it's not good, not for supervisors, not for banks, not for the banking community in Europe, that we are not in line with international standards. Of course, US standards are still open for consultation. We have to see what will be the ultimate outcome. But they make clearly the link between stronger guardrails and being more competitive. And as said, in 2017, Europe was the only jurisdiction around the Basel table considered as or qualified as material non-compliant with Basel. And I think, and I do not understand why the co-legislators were not more ambitious in addressing these issues. Linked to that, and I was quite and a bit in the same vein, I refer to a recent speech of Andrea and Ria to the Eurofi conference on the capital requirements between EU and US banks, where he clearly demonstrated that for GSIBs, not overall, for GSIBs, the US regime is clearly more stricter than the European framework as it is. And even if you make nuances that in the US you have, for example, you can lay off the lion's share of your mortgage portfolio, but even if you take that into consideration, the requirements for the GSIBs are much more stricter in the US compared to the EU. And with Basel III, that will not alter. So a bit concerned about the design and the signal that we are given in that respect. Of course, the US has other problems. I come to that. There is a scope. Basel is only applicable to a limited number of international active banks in the US. In Europe, it is broadly applicable to all banks. So that is the first issue on did we fix the past global financial crisis? Maybe not sufficiently convincing in Europe, having also in mind that there were a lot of transitionals in Europe. So we were in 17 already material non-compliant, and they added additional exemptions from the Basel package in the final package. And I'm quite surprised that some, like the vice chair of the ECB and Andrea and Ria and others, continue to pinpoint on that issue. So in Europe, first of all, we maybe have not fully convincingly closed the previous file. So now then I come to the current file, and Delphine alluded to the report of the Basel Committee that will be published soon. I will not repeat, of course, what Delphine already said with the 3 dimensions. It is bank management, risk management practices and governance arrangements, so the responsibilities of the banks, the supervision and the regulatory standards. I will comment on it with some additional, let's say assessments. First of all, I think the report, it is really well done. It is, I think, quite comprehensive, both in its analysis and in its proposed way forward on what's happening in the March events. The question is, and now, and there, is it sufficiently ambitious? Because a lot of what is identified, and Delphine alluded to that, are not really new problems. The issue of the role of AT1 instruments, the scope of application in of the Basel package. The scope, I mean both the fact that it is only applicable to international active banks. What are international active banks? Should it not be more broader? We've seen in the US that it's clearly that the impact of smaller institutions on the market as a whole can be significant, but also the fact that it's only at consolidated level. Also that definition or that issue is at stake. Liquidity, interest rate risk, Delphine alluded to that. So in my opinion, I think there will be we will need an impetus and let's say a focus and a push from the top. That means from the FSB, if we would like to change things in the regulatory side. And as Delphine said, there are indeed two dimensions. There is a supervisory dimension and there is a regulatory dimension. On the supervisory dimension, I have the impression, and again that's an assessment, that some would like to deviate attention to supervision, which is fine. There is clearly things to do, but I'm not sure that is the main issue for Europe. I come back to that in a moment. In that respect, a couple of reflections. Indeed, on supervision, I think the next thing is indeed more not only checking minimum requirements of capital and liquidity, but assessment of business models, assessment of governance, which is of course much more complicated than, you need sufficient tools in order to be able to react on the fact that the business model is not effective. To be honest, I think in Europe everything can be better, but there Europe is, in terms of supervision, especially the SSM, has done, I think, a reasonable job so far. That is, of course, different in the US, and the examples we have seen in the SFB, and you see it also in the report of the US authorities that they published as the lessons learned report. You saw clearly that there was an issue with supervision. For example, the processes were very complicated. In order to be able to act as a fear for litigation, there were complex and long processes which make de facto that supervisors could not operate in an effective way. But that is a political decision to give supervisors the tools and processes to act smoothly and swiftly. That was clearly not the case in the US. On regulation, also in the US, a lot has been said about the SVB cases and the others. SVB was not, Basel package was not applicable to SVB, not for interest rate risk, not for liquidity risk, stress tests were not applied. So there was clearly an issue of regulatory scope in the US. That was a decision of the previous US government to alleviate that. In the same vein, and you alluded to that, is operational preparedness. SVB had no liquidity line with the US Treasury. That is unthinkable in Europe. That is unthinkable in Europe. So there was no collateral pre-positioning in order to have access to the window facility of the US Central Bank. That is unthinkable, luckily, in Europe. Having said that, I don't think there is room for complacency, also not in Europe. And then quickly to the different items, but I will be rather short because there I think Delphine mentioned them already before. That is, first of all, on liquidity. I think what is now became clear on the floors and the liquidity requirements were not new. They came to the forefront as a result of what happened in the US. But I think we need to look at outflow rates, runoff rates of some assets like retail deposits, given that we are in the digital world, but that's not new. On HQLA composition, a more convincing Pillar 2 approach. Pillar 2 was mainly focused on capital, a more focused and more convincing Pillar 2 approach. That can already be done right now. Intraday liquidity, concentration of deposits, it has been said. The same for interest rate in the banking book. Traditionally, when Basel was designed, we were surprised that it was not part of the Pillar 1. Operational risk was much more complicated to calculate than interest rate risk, which is a basic banking risk. So again, the issue on the Pillar 1, Pillar 2 will re-emerge. But even within Pillar 2, we see, and it has been referred to, the outlier test is based on non-harmonized assumptions on the maturity of non-fixed term deposits. Also in Europe, I think we can still move on that. And more generally, these modeling assumptions for non-maturing deposits in the current interest rate environment. We have had for 40 years decreasing interest rates. We are now, of course, with the reversal of the monetary policy, with steep increase rates, I think we should very carefully look at interest rate risk in Europe also to see how, and Delphine said it, the behavior of retail clients in this new environment, having in mind that saving deposits now are used as a kind of a natural hedge for interest rate risk. If that starts to shift, given the new interest rate environment, that is, I think, quite fundamental, combined with the debates in most European countries on the remuneration of these deposits, that can create huge shift in the underlying assumptions. And then the last point I mentioned already, that is the scope, both on which banks should be in scope of the Basel package and the solo level, which is also, as you know, in Basel, it's only at the consolidated level. So I stop here as the main points that I see today.
Thank you very much, Joe, for this important interconnection, in fact, between the regulation and the supervision. And it's clear to me that although we've seen more soundness, in fact, in the banking sector in Europe in terms of capital, the Basel III is not fully applied and is still under discussion. We had a meeting here in June in CEPS on the compromise agreement, and some of the aspects of it were in a way watered down. And I think hopefully at least they will remain like this. Maybe they will be even further watered down. So as you clearly mentioned that we need to move to another step, which is the crisis, how to deal with the lessons from the crisis in the US, but we are still even dealing with the previous crisis, and this is the gap. So again, what Jose Manuel mentioned today was correct. It was a lack that the contagion didn't, move as fast in Europe. And probably this was, I don't know how we could explain it, but probably it's by, I would say, a lucky situation that happened. The second point, you mentioned also the behavior, the monitoring of the behavior of retail client. I think this is also an important, also raises the same point that you mentioned, Sebastiano. Many years ago, I remember at CEPS, we started to monitor business models of banks. That was in 2010. And really interaction between the asset and liability and getting deeper into the exposures, also the structure of the exposures on the asset side and also on the liability side. Of course, data is needed. I guess supervisors, they have much more data than academics have, but it's also important to have this data available for everybody to assess. And I think this is also, in the US, they have much more transparency in terms of data than, for example, in the case of Europe. Of course, the stress test, the transparency exercises are great. It's a first step in the right direction. But we need a bit more as academics to also contribute to the whole debate. So it could be interesting also to apply certain new methodologies of assessing this data. Thank you very much. Christian, so you heard a lot. I think you've been in this sector for a long time as Finance Watch. You're watching all this regulatory development and all this regulations and supervision. So what is your view and what should be done?
Well, Thank you, first of all, for giving me the opportunity to have a few thoughts from civil society on this. And as Joe has just done, I would like to effectively sort of bring this all back to the post-2008 discourse, where from the point of view of citizens, there were sort of huge expectations raised that the new frameworks based around higher capitalization, around resolution and bail-in would be calibrated in a way to protect citizens from episodes of crisis and ultimately from having to effectively sort of bail out too big to fail banks. Against that background, I think I would like to just briefly draw three summary lessons from the Credit Suisse and US episodes. I think the first one on Credit Suisse is that TBTF is alive and well.
Too big to fail.
Too big to fail is alive and well. It happened somewhere else, as José Manuel Campa was saying. The EU was lucky and dodged the bullet. It is interesting in a way to perhaps sort of tease out one angle of the Credit Suisse situation, which obviously has multiple ones, but resolution. So Credit Suisse had a resolution plan in place. Then, when the moment came, the Swiss Minister of Finance literally said, we've come to the conclusion that an international systemically important bank cannot be readily resolved according to its too big to fail plan. Which begs the question, why did Credit Suisse operate all this time, and why did the resolution authorities operate with a resolution plan that was apparently unrealistic and perhaps politically unacceptable along? Secondly, perhaps on that note, Credit Suisse has long had a reputation for risk-taking and for weak risk management. That was known to supervisors globally, not only in Switzerland, but of course specifically in Switzerland, which again begs the question, why was the bank allowed to continue as it did for a long, long time? Is this potentially a showcase of precisely the sort of moral hazard that we set out back in 2008-09 to put an end to? And would the outcome be different? Back to José Manuel's question, would it be different for a European GSIB? Second lesson, medium-sized banks can be a genuine source of systemic risk. Silicon Valley Bank being an example, and the way sort of the contagion sort of spread from there, and we've obviously seen that in Europe on multiple occasions. There are obviously sort of various angles, various aspects to tease out. One would be, as has been done by Delphine previously, in particular by Sebastiano, by Joe, the liquidity angle of things, access to ELA, all these things which perhaps are slightly different in Europe than they were in the US. However, especially with medium-sized banks, and especially against the background of the ongoing discussion, which I'm going to come on to in a moment, about a reform of the crisis management and deposit insurance system, I think it is quite interesting and it is quite remarkable to put the finger on what is a medium-sized bank in a European context. And then you bump into a variety of sort of a plethora of terms which unfortunately don't play well together. And I'm thinking about the concept of a significant bank within the SSM as opposed to an other systemically important institution under the sort of broader CRR-CRD framework, where, frankly, different rules apply, especially with a view to one being subject to an OSI buffer, another one not. And obviously, sort of these classifications have a very important bearing on what happens to them in resolution, because it kind of presages the fate and the tools that will be brought to bear. Thirdly, resolution remains rare. We've seen that, and optional. For every successful resolution, and I'm now looking at the EU, but clearly, sort of CS would be a similar case. For every successful resolution, there are at least 2 or 3 cases where where bail-in was avoided, public funds used, and every time, and this I think is the important one from the general public sort of perspective, every time public money is used, resolution loses more of its credibility in the eyes of the public, and that extends to its defenders, to all the institutions, to all the legislators and regulators who have invested credibility in that approach. Now, what lessons can we potentially learn, in particular against the background of the ongoing debate here in Europe about the CMDI package? Now, the CMDI package effectively sort of tries to repair resolution in a way. There is some general agreement that there are aspects of the resolution framework that don't work particularly well, focusing around, on the one hand, resolvability, especially if the large GSIIs and the large OSIIs. And that has to do with credibility of resolution plans, with doubts about loss-making capacity. We've heard about the famous 81 instruments, for instance. The sizing of losses absorbing and recapitalization capacity, i.e. MREL, and the interconnectedness. Second angle where resolution does not seem to be working is just the plain fact of a reluctance among policymakers to let go of an underperforming bank. Because in many cases, even where systemic risk was minute, member states would step in to support a failing institution rather than letting it exit the market in an orderly fashion. And I think we have heard time and time again from various sides of the spectrum here that Europe does have an issue with overcapacity and with underperforming banks. And clearly, sort of barring the door to exiting the market is not the solution for that. Also, on the deposit insurance side of things, there's clearly the discussion about a third pillar of the banking union, about a common deposit insurance, which could obviously then also take on some role in the broader context of stabilizing banks. That said, right now, almost half of the deposit insurance schemes in the European Union are not yet fully funded for the purposes that they already have on their task sheet, let alone new ones that would be allocated to them. Now, this brings me to sort of a number of issues with the CMDI, because I'm focusing on the CMDI because clearly looking at the Credit Suisse and the US cases, this discussion would be very, very timely to actually learn the lessons, incorporate them, rather than carry on with business as usual, which is unfortunately what a lot of the CMDI proposals, which do predate, in fact, Credit Suisse, to be fair, but a lot of it actually means. First of all, there is in the CMDI a proposal which actually rose back on the 2014 promise of burden sharing. As you all know, there is an 8% threshold that the investors, equity and debt of a failing bank have to contribute to covering the losses. It has been diluted already several times, as we know, starting back in 2016 with the Commission overruling the recommendation of the EBA. I'm not going to dwell on that. But it has been left largely to the SRB to keep this in place. and I think so far there's a good job has been done. But the idea of making funds from the deposit insurance scheme count towards the 8% burden sharing, to me, is a major issue that would again damage the perception of the public and the trust in the system materially. Going towards sort of wrapping up and just pinpointing a number of other issues here. The 8% rule, just to perhaps reiterate that issue, because the 8% rule obviously has been questioned because the current capital structures of quite a significant number of banks, deposit funded in particular, sort of might not, or it has been argued that they may not be in a position to actually fulfill that criterion. Looking back at the analysis that was done by the Commission with publicly available information very extensively in the context of the CMDI proposal, indicated that if other parts of the CMDI, in particular the harmonization of the creditor hierarchy, removal of the super preference of the creditor of the deposit insurance funds are put in place, 95% of the banks in the sample would be in a position, without tapping the DSG or without allocating sort of DSG money, to fulfill or to fulfill the 8% criterion. So we are talking about a sample of 30 to 40 banks within the 4,500 within the European Union, which the benefit of which is driving this part of the CMDI proposal. That, from a perspective of a citizen, does not sound right. The second big push in the CMDI proposal is to essentially modify the public interest test to effectively facilitate access to resolution authorities to a broader spectrum of tools, and to basically apply resolution tools more broadly. The issue there, however, is that the already very divergent practice among member states that we have seen so far would become even more divergent going forward at a time and in a situation where more standardized procedures and more predictability for failing banks would be, from our point of view and from the perspective of the general public, the order of the day. In order to wrap up and to really sort of perhaps put a wrap on things, where do we think are the touch points for us in the current environment to draw lessons from the events of this earlier this year? First of all, I think it is fair to say, and it has been said at this table several times, the likelihood of similar crises occurring and occurring even more frequently is very high. The likelihood of those crises occurring and eroding public trust in the financial system, in the banking system in particular, is commensurately high. Public trust is the backbone and is the bedrock of financial stability. Against that background, and in order to restore that trust and to ensure that the work that has been done so far actually does protect us in the next crisis as and when it strikes in the EU, there are really two points to consider. One is faithful implementation of the international standards and of Basel III as a starting point. And secondly, redesigning the the recovery and resolution framework in a way that puts resolvability at the forefront. And by that, I mean using the whole range of instruments already at the disposal of resolution authorities, including things that have rarely been done but are in the rulebook, like Article 17, which in effect enables resolution authorities to impose structural changes on banking groups that turn out to be too complex and intractable to devise a realistic resolution strategy. And finally, the maintenance and preservation of the 8% burden sharing rule, which really sort of is, I would say, symbolic for the citizen as a red line, a line in the sand, where basically the bank's responsibility begins and ends. Thank you.
Thank you very much, Christian. I think this is all very clear recommendations. Hopefully they will be taken into consideration, maybe not. So I would like to have any question from the floor. Also, I want to let you know that we have 50 people following us online. And we have 10 minutes of discussion. So anybody who has a question to the panelists? Yes, please introduce yourself and your organization.
So I'm Dominique Cariou. I'm the European Savings and Retail Banking Group. I just have a question on a curiosity about the date of implementation of the Basel, because in the US it was announced that they will implement on the 1st of July 2025. In the UK, they recently announced the same date. Just from a regulator perspective, I just would be interested to know if there is, I mean, if it would change something, I mean, to align in Europe with this date, or at the end, if there is no big difference. Thank you.
I can be rather brief. I don't think that is the major point, to be honest. It would be better that everyone is aligned, and aligned that means for once to the European rules, that is on the 1st of January 2025. It's not good that major jurisdictions have different implementation dates, let's be clear, but I think more importantly, far more importantly than the date of implementation, which is only, I would say, one minor feature, is the content. And as I said, I'm much more concerned about the deviations in Europe from the Basel standards compared to US and UK. So I would focus much more on the content than on the date of implementation, although I agree it would have been better that it would be aligned, but I don't think that is the major issue at stake.
More questions, comments on?
Yeah. No, I've done other questions. Otherwise, I wanted to address some comments by Christian. Of course.
No, but I want to give the possibility also to our attendees.
Just justify, because I think Dominique might expect also. Very quick, I completely concur with Joe has said, and it will not be also a surprise for you. I think what counts, and Joe mentioned it before, it's also, you need to consider the end of the transitional period as well as an additional criterion that might make a difference, even if, I mean, the implementation dates are not exactly the same. What counts also is the end date.
Okay, so I think I will move to the panelists. So what do you think about what Christian, so Sebastiano, and then Delphine, and then Joe?
Well, I mean, of course, interesting points, but allow me to contrast a few of them. Too big to fail doesn't work. There was a political declaration. I have not heard any other declaration similar to that. So there must be a fact. In Europe, we have had Banco Popular and Sberbank. Both have been resolved according to the framework. And that's a fact. It is true that there have been other cases that where you could have said, well, maybe that the framework could have been used, there were other solutions taken, etc., liquidation aid, preventive intervention. I think that the CMDI, which is a step in the right direction, is not the completion of the banking union, everybody knows, because you know that at least from the part of the European authorities, that's to say, from my point of view, no surprise, even when I had another hat, but we have always been in favor of the completion of the banking union for obvious reasons. I'm not going to entertain you on this now, but the CMDI is a step in the right direction because, contrary, I have to say, to what you think, Christian, but it tries to address a problem that has been noticed in the past, not even so recent, so past, but even recent, of essentially mid-sized banks, which are a category in between liquidation and resolution, but since we have certain rules that have to be respected, it may become difficult to address the crisis. And since one does not want to use public money, clearly, and wants to have a kind of more standardization and level playing field in addressing certain problems should they materialize, then the rationale is the proposal is an harmonization of the least cost test, a change in the depositor preference, the DGS, which always substitutes to cover depositors, is funded by banks, is not funded by taxpayers. This we know. And therefore, then to allow the funding where necessary, because it is not guaranteed that it is necessary, where necessary, after the MREL, because you have MREL before the DGS bridge where needed, you have MREL. This is what the proposal says. I mean, you have MREL because, I mean, I've done simulation on that, so on all the banks under our remit, and I can show you the results. So if I say that, believe me. And therefore, I mean, you have eventually the funding. In the case the loss is higher than MREL, already unlikely, but assume that, or you have to exclude some uncovered depositors because this is not guaranteed or written in paper that uncovered depositors have to be all excluded. But if there are problems of contagion, you have seen what happened in the US, but clearly the banks here would be lower size in that case, but there may be still connections because of the business model, because of similar type of investors, of depositors, etc., etc., then you may exclude them to arrive to the 8% of the fund in case you need the fund. Maybe that you don't need. So, frankly, I mean, and from the analysis that we conducted, we have seen that the impacts are totally reasonable and manageable. But we need, for the unlikely case that there is one of these banks that has a problem, we need the funding, because otherwise it is a problem to manage in an orderly way the resolution or even the liquidation. So that is the main point. Now, when you speak of the 8% has been diluted, etc., I'm not going to take here any political view on that. We apply the rules, and therefore we respect the 8% rule, which clearly, since this is a number of jurisdictions which have different specificities, exist in any other resolution framework. This exists, not in the US, not in the UK, not in other jurisdictions. But however, it is fine to have the right incentives. But frankly, nobody said that this would not be respected. So again, I think that here we have to be a little bit more precise. Now, on implementation of Basel III, I agree, faithful implementation. Resolvability at the core, fine. We are working on that, and we have published a couple of reports on the path to resolvability of the banks, what we will implement for banking union banks, of course, significant banks. In addition to the resolvability, let's say, regarding the various profiles on paper as shown by the bank, we want to subject the banks to an overall and holistic program of testing of these profiles of resolvability to see whether in practice what is declared in terms of preparedness works before the time of failure, if unfortunately it happens. And I agree with you, then if there are problems, there will be substantive impediment and eventually even structural changes. This, is something that the framework clearly envisages. However, on the fact that resolution remains rare and optional, rare, yes, because clearly we are prepared for each and every bank to be able to resolve the bank, but we are not there to hope that there are a lot of crises. So this would be very, very strange, from a public authority point of view. Yes, we would have a lot of work, but this is not what we are looking for. We want to have the right safeguards to be put in place. Optional, not. Frankly, I disagree. That's to say, we have had a case of Credit Suisse. Fine. They decided something else. There is still debate ongoing. As I told you, it seems to me that it is more implementation issues rather than adequacy of the framework, because you could have done the same type of operational likely in resolution and not outside of the resolution. So clearly, it was a decision taken. And we of course respect, and we have to acknowledge, by the way, that the measures taken restored financial stability immediately, which is clearly important for everybody. So I understand that when there are issues of banking turmoil, there are always debate, the framework work, the framework doesn't work, why we set up all this overarching structure, etc., etc. But the point is that in our view, the framework is well designed and works. There are always pressure points, and there are also difficulties in implementation. So this is a path where, essentially the jurisdictions in 2015, 14 or 15 started from zero. So this has to be acknowledged. Supervision has how many years? Many, many years. I spent already myself 35 years in supervision. Then I switched to resolution. So must be much older than me. No? So you see, there is also some path to be performed. And now we are at the moment where we believe that, we go to increasingly to operationalizing the various tools, as I did, the flexibility, optionality, the high-level tests of the resolvability profiles, but it is a process, learning by doing. Thank you.
Thank you, Sebastiano. Joe, would you like to add anything? Delphine? Okay, with this, I think we had quite an interactive and quite lively discussion between the panelists. I think I would go back to what Jose Manuel said this morning. I think there are elements of luck why the contagion didn't move to Europe, and I think hopefully we will have this luck until the implementation date of Basel III. So let's hope for the best. And I thank very much the panelists. Thank you for all the audience for your patience and for your attendance, and everybody who was connected online. And I would like to thank SEPS and everybody else for the organization.